What's going on, everybody? This is Curtis. Now, before I begin, I just want to say that this is a financial information channel and not a news channel. I feel terrible for the people of Ukraine and hope that this conflict is resolved as soon as possible. This video does focus on the financial implications of what's going on with the war in Ukraine and is not meant to downplay anything that's happened over there on the humanitarian side of things. And like I said, I hope this conflict is resolved as soon as possible. Okay, so at the time of writing this, there hasn't been too much financial fallout due to the war in Ukraine so far. Yes, gas prices are up, but no large hedge funds have blown up and we aren't worried about financial failure in US institutions. However, what if this is just the calm before the storm and we are merely weeks away from a financial catastrophe? Now, I'm not saying this is going to happen, but most people, including myself here, are pretty unaware of how financially interconnected the entire world is at this point. Perhaps some lessons from the past can help enlighten us on the potential issues we might be running into here based on the violent financial swings we've seen over the last couple weeks. Now, over the summer, you might remember that Evergrande was set to collapse, and there were some potential rumblings about the implications of that going down, but that actually didn't materialize as people sort of speculated. I'm sure a lot of you right now are thinking that in 2008 and during the pandemic, there wasn't really an external factor that, some foreign issue that caused a major chain reaction here that impacted our markets in the US. But I'm thinking back a little bit further than that. So why would an issue with Russia cause a problem back here in the US? What I'm worried about here is some financial institution that has outside exposure to Russia via something like a bank, energy company, bond, or currency. If they were levered up and have since blown up due to the massive shock to the system, this could cause massive price fluctuations, and because they were levered, issues from banks that loaned them all that money. Those who know your financial history might realize that I'm talking about what happened to LTCM, or long-term capital management. LTCM is an important lesson from history and shows us that we need to be alert to violent price movements and the impact they can have on the financial markets. So what happened to LTCM? Back in the 90s, LTCM was one of, if not the hottest hedge funds on Wall Street. It was founded by John Meriwether, who was the head of bond trading at Salomon, and strategies were run by Nobel Prize winners Myron Scholes and Robert C. Merton of the famed Black-Scholes-Merton option pricing formula. They had all sorts of complicated models and hedging strategies which helped them generate market-beating returns. One of the ways they generated these returns was by taking advantage of the differences in price between the newly issued 30-year bond and the previous month's issue. This spread would eventually go to zero, which over time allowed them to collect the difference. But because this was such a small price difference they were taking advantage of, they had to lever up a lot to take advantage of that and actually make it worth their while. Now, this is not their only strategy, but this is an example of what they would do and shows how they would lever up to take advantage of these arbitrage situations. So then if we go back to 1998, the firm had capital under management of $5 billion, was levered up to $125 billion, which is 25 to 1. And then because of the nature of the derivative trades they had on, their positions had an actual notional value of $1.25 trillion. Yes, that's $1 trillion in notional value with just $5 billion in equity. So if this hedge fund was run by one of the best traders on Wall Street and the strategies were run by two of the smartest people, in fact, Nobel Prize winners, how did this all go wrong? Well, the Russian ruble's what happened. In August of 1998, Russia defaulted on its debt. The common thought at the time was that you couldn't default on your own debt because you could just print more money. But it turned out to happen. This, like most times of crisis, caused people to flee for safe assets. The net effect was that it pushed LTCM's positions the opposite direction of where they expected them to go. Now this, coupled with high leverage, as most people know that have ever used leverage, causes losses to mount very quickly. So normally one hedge fund with a few $1 billion isn't big enough to potentially pull down some other financial institutions, but this is exactly what happened because of the massive amount of leverage that long-term capital management was using. And the real people at risk here were the banks that loaned them all that money. LTCM could really only lose the equity they'd put into the fund, the $5 billion. But the banks were on the hook for a whole lot more than that. Now, why would banks loan them so much money? Well, I mean, these guys were Nobel Prize winners, and who's some risk manager at a bank to tell a Nobel Prize winner he needs to take down his exposure? It was assumed that these guys were very much well aware of what they were doing and had very complicated risk models to assess potential losses they could ever incur. Well, that's not what happened. The positions were going against them, and they needed to liquidate and basically get out of these trades really fast to stop the bleeding. Since they had to get out of these positions here, as we've seen in financial markets, when someone has to sell, Other buyers come in to give them a nice safe landing to make sure that they can get out of positions in a nice calm and orderly fashion. No, that's not what happens at all. Other funds smelled blood in the water and did the opposite of LTCM's trades, which pushed the spreads wider and wider and exacerbated the losses because they knew that if they pushed LTCM enough, they had to close these positions. Needless to say, the banks were on the hook for some major losses here. The Federal Reserve Bank in New York organized a bailout to halt the contagion to the rest of the financial system. Overall, what looked like just a bad event for Russian debt holders, in actuality, through the interconnectedness of the financial system, nearly caused a major crisis back here in the US. Okay, so let's tie this all back to the situation at hand. Russia has effectively been cut off from the Western world. ETFs and mutual funds that track the Russian market have stopped trading. Oil has fluctuated like crazy. More than 1/4 of the globe's wheat exports come from Russia and Ukraine. The food implications on the largest importers like Egypt, Turkey, and Bangladesh are yet to be known. And we've also seen the price of nickel jump 200% over the last year. So what's the major takeaway here? While we've certainly learned lessons from the past, so I wouldn't expect a Russian default to send shockwaves through the financial systems like it did last time, this conflict could cause what was a relatively orderly market to jump higher and lower across a number of assets, and I don't even think we know the outcome of that just yet. Again, while I'm not saying there's going to be a major crash or even a near miss, this event certainly has all the ingredients to cause one, and it is wise to keep your eyes out for rumblings of potential trouble ahead. Well, that's all for this video. If you enjoyed, please leave it a like. Don't forget to subscribe for more content, and I'll see y'all next time.